Welcome everybody to another episode of FITCSP, Financial Independence Through Common Sense Practice. Today I want to talk about refinancing your home and why now is a good time to do so. In this video, I'm going to cover some of the benefits to refinancing your home and give you some things you need to review before considering refinancing. So stick around for more right after this. Thanks for sticking around. My name is Austin, and what I like to do here is give motivation and advice on how to become financially independent. Before I get started, I want to start off by saying I am not a mortgage loan officer, and you should consult a reputable mortgage loan officer before you make any moves. This video is strictly for informational purposes only. Now, refinancing your home could be the furthest thing from your mind right now. When you originally got the mortgage, you probably thought you had a good interest rate, and you might have done the standard 30-year term. Most people don't look at what the current rates are as time goes on. There are a lot of people who have what we would call today a high interest rate mortgage, anywhere from 5% and higher. If you didn't know, now you know that you can refinance for a lower rate. Rates are now in the 3% range, and in some cases I've seen rates in the 2% range. Those are excellent interest rates. Now rates can change at any given moment, so you have to move fast if you want to refinance. Since the rates are historically low at this time, I wouldn't want you to miss out on this opportunity to benefit from a lower interest rate. Think about how much you would save in overall interest if you were able to lower your rate. If you have an interest rate over 4%, you should truly consider refinancing. Imagine what you could do with the money you are saving if your mortgage payment was lower. We don't know how long the rates are going to be this low, and if you aren't thinking about moving anytime soon, why not get the best deal on your mortgage payment? Also, if you refinance, you don't have to start your term over. That's one misconception that most people think. The choice is up to you to either extend it out or shorten the term. Now, let me get into some of the benefits to refinancing so you can understand refinancing a little bit more. Getting a mortgage with a lower interest rate is one of the best reasons to refinance. Since the interest rates have dropped, you could refinance for a shorter term, which will cause you to pay back significantly less in interest and the loan off faster. Even if you don't want to shorten your term, you can extend your term, which will lower your monthly payment, and you can use what you are saving to pay toward other items. Another good reason to refinance is to take out the equity to do what they call a cash out refinance. A cash out refinance is when you take out a new mortgage loan for more money than what you currently owe and receive the difference in cash. What you could do with those funds is pay off some debts, cover a major expense, or remodel your home. So let's say you have a mortgage that you owe $100,000 on. You now want to take out some of the equity to pay off some of the debts and you need $25,000. Now you will have a new mortgage for $125,000. Another good reason to refinance is if you have an adjustable rate mortgage and you want to convert it over to a fixed rate. Since your rate is adjustable, you can go ahead and get it lowered without the worry of it going up in the future. Like I said before, we don't know how long these rates are going to be low like this. Lastly, if you bought your home and you didn't put down 20%, you are paying PMI, which is private mortgage insurance. Now that home values have increased significantly, you have enough equity to refinance your home and get rid of the PMI. Most mortgages require that the PMI stay on the mortgage for the life of the loan unless you refinance. PMI can be as low as $50 and it goes up depending upon how much the loan amount is. So if you are able to refinance and remove the PMI, then that will be saving you something. Now I want to get to some things that you need to know when you are considering refinancing your mortgage. Just because the mortgage rates are low doesn't always mean refinancing is a good option at this time. The decision to refinance should be based on your personal financial circumstances. I now want to go over 5 things that you need to review before applying for a home refinance. Number 1, know your home's equity. In order to remove the PMI, you will need to have at least 20% equity in the home. If you don't have at least that amount of equity, then when you refinance for a lower rate, you are still adding that cost back into your loan. That cost is something to consider if you are looking to save money when doing a refinance. Number 2, know your credit score. Since the mortgage crisis back in 2008, lenders have tightened their standards for loan approvals. You want to make sure you have the highest score possible to get the lowest rate. Even if you don't have excellent credit, you can still get approved. Just understand that the interest rate and fees you might pay may be higher. When shopping around for the best rate, ask the lenders what is the minimum credit score requirement and what score do you need to have to get the best rate that they are offering at that time. So that way, if you already know what your credit score is before applying, you can have an idea of what rate you are looking at. Number 3, know your debt to income ratio. If you already have a mortgage loan, you may assume that you can easily get a new one. That is not always the case when you have a high DTI. That makes your overall chances of getting approved slimmer. Most lenders want your DTI to be 36% or less. Now, some lenders will go up to 40% or higher depending upon if you have positive factors like a high credit score, high income, stable job history, and if your overall accounts are paid on time and in a good standing. So if you have a high DTI, you may want to pay off some of those debts before refinancing or considering doing a cash out refinance to consolidate all of the debt. Number 4, closing costs. Refinancing a home can usually cost between 3 to 6% of the total loan amount. Some lenders will allow you to roll the closing costs into the loan, which will add an increase to the principal loan amount. Now, you will need enough equity to do so. You can even find lenders who offer no cost refinancing. With that though, your interest rate might be slightly higher to cover them not charging you closing costs. So when you are considering refinancing, don't forget to negotiate and shop around because some refinancing fees can be paid by the lender or even reduced. Number 5, rate versus the term. While many people focus on the interest rate, it's important to establish your goals when refinancing in order to determine which mortgage product meets your financial needs. If your goal is to reduce your monthly payment as much as possible, then you will want a loan with the lowest interest rate for the longest term. If you want to pay less interest over the length of the loan, then what you want to look for is the lowest interest rate for the shortest term that has payments that you can afford. So the key is to establish your goals and look at your bigger financial picture. Like many financial transactions, mortgage refinancing is complex and does require due diligence. If you have any questions, remember to speak to a reputable lender to address any concerns. If it seems like a good move to refinance, make sure you do your research and consider the points I made earlier. Thanks for watching another episode. If you found value in this video, consider subscribing to the channel for more ways like this to become financially independent. Also, hit the like button and share with a friend. You can visit my website, FITCSP.com, if you want to book a coaching. Don't forget my ebook, Credit and Common Sense Form, that's available right now. Until next time, peace.